Imagine waking up one morning and checking the silver price, only to see it has exploded past $200 an ounce, then $300, then $4, and eventually touching $500. Sounds crazy, right? But what if I told you that some of the smartest money managers in the world are quietly preparing for exactly that scenario? And no, this isn't another hype video from a random YouTuber. This is Macro Truth, and we dig deep into the real forces moving global markets. Today, we are not just talking about a silver rally. We're talking about a complete repricing of monetary metals, a potential short squeeze bigger than anything we saw in GameStop or AMC, and a perfect storm of supply, demand, and financial system fragility. That could send silver to levels most people think are impossible. Stick with me for the next 20 minutes, because by the end of this, you will either be convinced that silver is the most undervalued asset on the planet, or you will at least understand why so many contrarian investors are betting their entire portfolios on this trade. And before we go any further, if you want more hard-hitting market analysis without the mainstream fluff, hit that like button and subscribe to Macro Truth right now. It helps us keep delivering these deep dives, and trust me, you don't want to miss what's coming. Let's start with a simple question. Why would silver, a metal that most people barely think about, suddenly jump from around $23 an ounce to $200 or even $500? That is a 10 to 20 times increase. To put that in perspective, if gold did the same thing, it would be trading at over $20,000 an ounce. Sounds absurd, but history is full of moments when precious metals repriced dramatically. In the 1970s, silver went from less than $2 to nearly $50 an ounce in just a few years. That's a 2,500% move. Adjusted for inflation, that $50 peak would be over $200 today. So the idea of $200 silver is not science fiction. It has already happened in real inflation-adjusted terms. The only difference is that today's setup is far more explosive than anything we saw back then. Now let me walk you through the core drivers. Number one is the industrial demand explosion. Silver is not just a monetary metal like gold. It is the single most conductive element on Earth, which makes it absolutely critical for the green energy transition, electric vehicles, solar panels, 5G networks, and even artificial intelligence hardware. Every single solar panel requires about 20 grams of silver. Every electric vehicle uses about 50% more silver than a traditional gas-powered car. And with global governments pushing for net zero emissions by 2050, the amount of silver needed for solar alone is projected to consume more than the entire annual mine production within a few years. The Silver Institute recently reported that industrial demand hit a record high last year, and the deficit between supply and demand is now the largest in over 20 years. But here is the kicker. Most people don't realize that silver mines are actually running out of high-grade ore. The average silver ore grade has fallen by more than 50% over the past 2 decades. That means miners have to dig up twice as much rock to get the same amount of silver. And opening a new mine takes 10 to 15 years on average, thanks to environmental regulations, permitting delays, and massive capital costs. So even if the price doubles or triples tomorrow, new supply cannot come online fast enough. The second driver is the monetary and financial system angle. Central banks around the world have been printing money at an unprecedented rate. The US national debt is now over $34 trillion and climbing fast. Interest payments on that debt are approaching $1 trillion a year, which is more than the entire defense budget. To keep the system from imploding, the Federal Reserve will eventually have no choice but to lower interest rates and restart quantitative easing, which is just a fancy term for creating money out of thin air. When that happens, the purchasing power of every dollar in your bank account gets diluted. Historically, investors have flocked to gold and silver as a store of value during these periods. But silver is actually more sensitive to monetary inflation than gold because it is a smaller market. A relatively small amount of capital flowing into silver can push prices up much faster than gold. Think about it this way. The total above-ground silver in the world is worth about $1.5 trillion. The total above-ground gold is worth over $12 trillion. So if just 1% of the global bond market, which is over $130 trillion, decides to move into silver, the price would have to go up by multiple factors to absorb that capital. And we are already seeing signs of this. Central banks have been buying gold at a record pace for the last 2 years, but silver is next. Wealthy families and institutional investors are quietly accumulating physical silver because they know that paper silver futures on the COMEX are a disconnected game. That brings me to the third and most explosive driver, the massive short position in the silver futures market. For decades, a few large bullion banks like JP Morgan and HSBC have been manipulating the silver market by selling huge amounts of paper silver futures contracts that are not backed by physical metal. In other words, they have been creating fake silver out of thin air to suppress the price. This is not a conspiracy theory. In 2020, JP Morgan paid a nearly $1 billion fine for manipulating precious metals markets. The evidence was overwhelming. But even after that, the short positions remain enormous. Right now, the ratio of paper silver contracts to physical silver available for delivery is somewhere between 200 to 1 and 500 to 1, depending on how you measure it. That means for every ounce of real silver sitting in a vault, there are hundreds of claims on that same ounce. This is a recipe for a catastrophic short squeeze. When the physical buyers start demanding delivery instead of just rolling their contracts, the banks will have to go into the open market and buy real silver to settle those contracts. But as we already discussed, there is not enough physical silver to go around. The price would have to skyrocket to encourage hoarders to sell and to bring demand down. That is exactly what happened in the silver squeeze of 1980 when the Hunt brothers tried to corner the market. And it's what happened more recently in early 2021 when retail investors piled into silver mining stocks and pushed the price up nearly 30% in a week. Now imagine that same dynamic but with a much larger base of institutional buyers, a severe supply deficit, and a Federal Reserve that is about to start cutting rates. The short squeeze potential is off the charts. Let me give you a specific scenario. Imagine the Fed announces its first rate cut later this year. The dollar weakens. Inflation expectations rise. Large funds start rotating out of treasuries and into hard assets. Silver breaks above $30, then $35, and then $40. At $40, the short sellers start to panic because they are losing money on their paper shorts. They have to buy back their positions, which adds fuel to the fire. Then the media starts talking about silver. Retail investors jump in through exchange-traded funds like SLV. But here is the problem. Many of those ETFs don't actually hold enough physical silver to back their shares. They hold a mix of futures and allocated metal. When redemption requests surge, the ETF managers are forced to take delivery of physical silver. But the COMEX warehouses have only so much registered silver available for delivery. In fact, at current prices, the total registered silver on the COMEX is worth less than $5 billion. That is nothing compared to the hundreds of billions that could flow in. So the COMEX would have to raise margin requirements or even suspend trading, which would cause an even bigger panic into physical metal. At that point, silver would rip past $100. The miners would be making enormous profits. Then the price targets get revised higher. $200 becomes the new baseline. Some analysts, like those from the Silver Institute, and even a few former Goldman Sachs commodity heads, have floated the idea of a repricing to $500 in a true systemic crisis. That is not a prediction for next month, but over the next 3 to 5 years, as the debt crisis unfolds, it is entirely plausible. Now, I know some of you are thinking, but what about the economy? If silver goes to $200, doesn't that mean everything else is collapsing? And you're right. A move to $500 silver would likely coincide with a major loss of confidence in fiat currencies. That means stocks could crash, bonds could default, and real estate could plummet in real terms. But that is exactly the point. Silver is not a growth investment like tech stocks. It is a preservation of wealth when the financial system is under stress. Think of it as insurance. You don't buy insurance because you expect your house to burn down. You buy it because the cost of not having it is catastrophic. And right now, the premiums for silver insurance are incredibly cheap. At $23 an ounce, silver is still below its all-time inflation-adjusted high from 1980. Gold, by contrast, is near its all-time high. So on a relative value basis, silver is historically cheap compared to gold. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, currently stands around 85 to 1. The historical average is about 50 to 1. And during periods of monetary crisis, that ratio has often fallen to 20 or even 15 to 1. If the ratio simply returns to 50 to 1 with gold at $2,500, silver would be $50. If gold runs to $3,500 during the next crisis, and the ratio drops to 20 to 1, silver would be $175. And if gold goes to $5,000, which many hedge fund managers are predicting, and the ratio hits 15 to 1, you get $333 silver. That is how you get to the 200 to 500 range without any magic or manipulation, just simple math and historical precedent. Let's talk about what could go wrong, because I always want to give you a balanced view. The biggest risk to this thesis is that the Federal Reserve successfully engineers a soft landing. Inflation comes down to 2%, the economy grows steadily, and no major bank fails. In that scenario, silver might drift sideways or even lower as industrial demand softens. But ask yourself, how likely is that? The US government is running a 6% of GDP deficit in a time of full employment. That is unheard of. Usually, deficits shrink when the economy is strong, but here they are expanding because of interest costs and mandatory spending. That is a structural problem, not a cyclical one. The only way to fix it is to inflate away the debt, which means the Fed has to keep interest rates below the inflation rate for a sustained period. That is negative real interest rates, and negative real rates are rocket fuel for precious metals. Another risk is that the COMEX changes its rules to allow cash settlement instead of physical delivery. That could postpone the squeeze, but it would also destroy confidence in the futures market. Once investors realize that paper silver cannot be exchanged for real silver, the premium for physical metal would explode even higher. We saw a preview of this during the COVID crisis when the COMEX temporarily could not deliver gold, and the futures price decoupled from the physical price by over $50 an ounce. For silver, that disconnect could be hundreds of dollars. So even if the paper price stays low, you would not be able to buy physical silver anywhere near that price. That is effectively the same as a price explosion for anyone holding real bars or coins. Now let me give you a timeline. I'm not saying silver will hit $500 next week. These things take time. The first phase, which we are probably in right now, is accumulation. Smart money is buying physical silver quietly, not making a lot of noise. The second phase is the breakout above $30, which will attract technical traders and momentum funds. The third phase is the short squeeze, which typically happens when silver moves above $40 and the paper shorts realize they are trapped. That is when the price can jump 50% in a matter of days. The fourth and final phase is the mania phase, where the average person starts piling in because they see their neighbor getting rich. That is when we could see $200, $300, or even $500 silver. Historically, manias always overshoot to the upside because nobody wants to be left holding worthless dollars. My best estimate is that phase 1 takes another 6 to 12 months. Phase 2 and 3 happen over the next 1 to 3 years. And phase 4, if it happens, would be in a full-blown currency crisis sometime between 2026 and 2028. But remember, markets are forward-looking. The price could spike much faster if a major bank or hedge fund blows up, triggering a rush to safety. You might be wondering, how do I actually position for this if I believe it? First, do not buy paper silver futures unless you really know what you're doing. The leverage can wipe you out. Second, be careful with mining stocks. They offer leverage to the silver price, but they come with company-specific risks like management, debt, and political instability. A better way for most people is to buy physical silver in the form of 1-ounce rounds, 10-ounce bars, or 100-ounce bars. These are easy to store and sell. You can also buy allocated silver in a reputable vault if you don't want to take delivery at home. Another option is the PSLV trust, which actually holds physical silver in a vault and allows you to redeem for metal. Avoid SLV because it has a history of paper shenanigans. And finally, allocate a small percentage of your portfolio, maybe 5 to 15%, not everything. Because even though I am very confident in the setup, nothing is guaranteed. The system could stay irrational longer than you can stay solvent. But if you are patient, and if the macro truth thesis plays out, the next few years could be the wealth transfer event of a lifetime. Before we wrap up, I want to share something most analysts won't tell you. The central banks and the bullion banks know all of this. They have been preparing for years. JP Morgan, the same bank that was fined for manipulation, has been accumulating massive physical silver inventories. They own hundreds of millions of ounces. They are not doing that because they think the price is going to $20. They're doing it because they want to be the ones supplying the market when the shorts get squeezed. The insiders are already positioned. You have the same information they have. The only question is whether you act on it or watch from the sidelines like most retail investors did in the 1970s and then spent the next decade kicking themselves. So here is my call to you. If you found this breakdown valuable, do not keep it to yourself. Share this video with someone who needs to hear it. Comment below with your own price target for silver by 2030. Do you think $200 is realistic, or are you in the $500 camp? I read every comment, and the best ones might get pinned. Also, make sure you have subscribed to Macro Truth with the bell turned on so you get our next deep dive, which is going to be on the coming bond market crash and why treasuries might be the most dangerous asset in your portfolio. As always, stay curious, stay skeptical, and stay invested in real things. This is Macro Truth, signing off.